Okay, welcome to the December 20th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a little bit about our usual stuff, what's going on in the vegetable oil markets, talk a little bit about the implications of the NOPA report that came out, and EPA published their November data from the EMTS. So let's get started. I also think I finally figured out what was wrong with my charts and stuff. So hopefully it will work this week. Okay, so just a quick update on Argentine weather. It remains dry, but the forecasts for La Nina are tending to suggest that La Nina will end a little bit earlier than previously expected. The timing, the way that they do the forecast is in sort of 3-month chunks, so like Dec, Jan, Feb. So the timing is not super specific, and there's a huge difference between whether the La Nina ends in December, and I guess December is almost over, so it's not like the end in December, but whether it ends in January, February, March, or April. The later that it ends, the worse it will be for the South American crop. And conditions down there were supposed to improve at the end of the month with a pretty significant system that was forecast for basically the last 10 days of December. Now, that forecast has been reduced as it's sort of come closer to verification, which isn't unusual when you get forecasts for changes in patterns that are like near the end of the forecast period, so that are close to 2 weeks out or 15 days out. As the models go forward in time, they tend to rely more on climatology and less on current conditions, although current conditions obviously still play a role in the forecast. And so it's not unusual to have models where conditions are drier than normal predict rainfall at the end of the forecast period that doesn't necessarily verify. Unfortunately for Argentine producers, that rainfall is really critical, both to support the plants that are already in the ground, but also to finish up planting. It's been dry enough that it has delayed Argentine planting. And so I think farmers were probably really looking forward to that rainfall so that they could get basically the rest of the soybean and corn crops in the ground. And while the amounts have been diminished, there still is a system that's predicted to generate rain by the end of the month, which still will help. Basically for Argentina, what they need is to be able to get the plants to, or get the crop to the point where La Nina fades and rainfall starts to increase. Now, again, even though NOAA has suggested that La Nina could end earlier, and there are some data points that suggest that that all makes sense. So if you look at sort of not the sea surface temperatures, which is what they use to determine whether we're in La Nina or El Nino, but if you look at the subsurface temperatures, there's a substantial amount of warmer than normal water below the surface that has continued to sort of move eastward. And the expectation is that that will start to well up and get to the surface. And that's what's going to end the La Nina. Again, whether that happens sooner rather than later will be critical for the Argentine crop, and also the crop in southern Brazil. I've said before that, you know, we can probably lose 10 million tons out of the Argentine crop as long as Brazil is 150 million tons or 153 or whatever. However, if conditions don't change and the dryness impacts the crop in southern Brazil as well, then you get to a point where it the weather and the crop loss down there starts to become critical. I don't think, given how the rest of the Brazilian crop is developing, I don't think we get to a point where, I think I spoke a couple of weeks ago about, hey, there's some potential here in sort of the worst case scenario where we really have to ration soybean demand, and so prices need to go up to crazy levels. Based on what we've seen so far in the South American growing season for the majority of the Brazilian crop, I don't think that we're going to get to that point. And if La Nina ends in January or February, then probably you have a relatively small reduction in the Argentine crop and relatively small reduction in southern Brazil, and overall you have a crop that is substantially larger than last year and probably keeps soybean, and by extension sort of soybean oil prices, relatively in check. And so I think that's probably the most likely outcome, but again, it will depend entirely on exactly when La Nina ends. This week we got the NOPA crush report. NOPA crush came in a bit below market expectations. It was in line with our forecast, which had been revised lower. So we were a little bit lower than, see if this actually works. We were a little bit lower than USDA's December forecast. So the fact that the November NOPA crush data came in line with our expectations suggests that we're probably on the right track, and we're down about 40 million bushels from where we were before the EPA released their mandates for 2023 through 2025. The NOPA stocks data was a little below where we were expecting, a little bit closer to market expectations, but it wasn't substantially below our forecast. However, the NOPA data combined with our estimates for trade flows and our estimates for biofuel feedstock consumption suggest that non-biofuel demand slowed pretty dramatically in November. So non-biofuel demand in October looks like, depending on what the biofuel feedstock numbers are, but it looks like it's about 1.4 billion pounds. And the NOPA data implies that probably dropped to just under 1.2 billion pounds in November. Now, because non-biofuel is a residual number, it tends to be really volatile. And so if you look at sort of the average for those 2 months relative to the average of last year, then you can get maybe a better sense of what's going on. Of course, the slowdown could be real, and it could mean that going forward that non-biofuel demand is going to be weaker than expected. But if we just look at those averages and compare them to last year, we're about in line with where we were last year, which would suggest that last year we were at 14.4 billion pounds and we're at 14.5 right now. I'm pretty comfortable with that, as long as November isn't a sign of things to come and the demand is weaker. Now, the demand can be a little bit weaker for maybe a month or so, because right now, if you look at my forecast for non-biofuel demand, my monthly forecast going out forward, by the time we get to the end of the year at 14.5 billion pounds, the implied forecast for September is lower than what it's likely to be. And typically what that means is that I either need to cut demand in some other months, or I need to raise my marketing year forecast. And I don't think I want to raise the marketing year forecast. And I want to see whether this November number verifies, and then if it does, whether we get follow-up weakness in December and January. And if we do, then maybe I'll start to cut. But at the moment, just the average for the first 2 months, if you just took that and suggested that that was the usage over the balance of the year, it would imply usage of like 15.6 billion pounds, which obviously is too high, but it's strong enough to make me not want to run and cut my non-biofuel forecast from where it is right now. The interesting thing, I think, will be to see where biofuel demand goes over the next couple of months, or over the next couple of months that the EIA reports. So they'll report October at the end of this month, and then November at the end of January. And it really will be sort of the December forward data that I'm kind of really looking forward to, because with the change in, I guess, market expectations for biofuel production going forward, which again range from sort of our expectation, which I think is probably at the lower end of the range of possible outcomes, to other analysts that are substantially above where we are. USDA here is 1 billion pounds of soybean oil usage above where we are. I think that the impact of that in sort of January and February, even though those months tend to be, just from a seasonal perspective, tend to be lower production months, and then the ability of canola oil to generate RINs, it'll be interesting to see how all of that sort of shakes out and the impact on soybean oil demand. I don't think personally that that canola oil usage will be huge. Going forward, I kind of have canola oil usage combined biodiesel and renewable diesel. I kind of have relatively flat. So I've got it 1.3 billion pounds in 21-22 and 1.45 in 22-23, and then I don't have it really growing significantly. I've got it growing kind of slowly going out, if you go out for 5 years or 10 years past that. Well, however, there were anecdotal reports suggesting that some renewable fuel producers were buying canola oil in anticipation of the approval of the final pathway. That doesn't mean that, you know, we're going to increase canola oil usage by 1 billion pounds, but it does mean that there's going to be some canola oil usage, and that makes sense. There are some renewable diesel producers where their location makes sense to use canola oil. So West Coast producers in sort of the Intermountain region, kind of Montana, Idaho, that area, canola oil can make sense there, and then maybe even in the northern Midwest, although there aren't a lot of renewable diesel producers up there. And so it's possible that canola oil usage could be stronger than I'm expecting. And that's part of why I want to kind of see what the numbers say for January and February. And then I think I can get a pretty good handle on what it's going to look like going forward. And that will also tell us a lot about what's going to happen in the soybean oil market. So before the mandates came out, I had expected that we would probably need to import a lot of canola oil, not necessarily for biofuel production, but to substitute for non-biofuel soybean oil use. And we saw the spread between canola oil, our assessment of canola oil prices in Los Angeles, and the soybean oil price in central Illinois. That spread came down to like 2 cents, which is less than the logistical difference between the two locations. suggesting that canola oil would be really competitive in the feedstock mix. Now, this past week, that spread started to go the other way and actually rose like, I think, 3 cents. So it's back to like 5.5. The long-term average for that spread is around 7.5, maybe a little bit higher than that. It kind of, obviously, it kind of depends on what period you pick. There was a relatively long time where it was about 9.5 cents. So maybe it's as high as 9.5 cents, but I would say probably somewhere between that 7.5 and 9.5 cent range. And if we see the spread go back up there, then I think that canola oil use in biofuel production will probably be pretty close to where we expect it to be. Again, huge caveat there. I might just be blown away and we get the January data and canola oil usage goes from, 130 million pounds a month to 250 million pounds a month or something like that. But I think if that spread continues to widen, the chances that something like that happens probably decrease. I also think that whatever the use in sort of January and February are, while they will give me a good idea of what's going on, it may also be that that usage in those months is a little bit higher than it will be for going forward, sort of the equilibrium usage going forward, just because some renewable diesel producers had already bought canola oil in anticipation of the pathway and want to use it. So again, that part will be, I think, relatively interesting. The other area where you're starting to see an impact from the lower mandates is the canola crush in Canada. So that has slowed a little bit last week and then pretty dramatically this week, to the point where we reduced our forecast for Canadian canola crush in February by 110,000 tons to 745, I think. That doesn't quite sound right, but it was a significant cut. Now, not significant enough yet to where I want to reduce my Canadian crush forecast number from 10.4 million tons, essentially. However, it is enough that if that trend continues, and again, let's say that spread continues to trend higher, that would reduce the demand for U.S., or it would imply a reduction in the demand for U.S. imports and the pressure on Canadian crushers, and it would free up some canola to be exported. Canola exports in October were strong. October is typically a strong month for Canadian canola exports, and this year was no exception. The total was like 1.1 million tons, which was up a little bit from last year. The thing that happened last year, though, was after it was like 1.06 million tons last year. Then you saw a pretty sharp deceleration after the peak in October. This year, I would expect that deceleration that reduction, month-over-month reduction in Canadian canola seed exports is probably going to be a little bit smaller than it was last year. And if canola oil usage in biofuel production is not as strong as expected, or is I suppose closer to my expectations, then I would think that trend may continue, and that I may need to reduce my forecast from the 10.35. Now, if I do that, I will probably add whatever reduction I make to exports, again, depending on what the November data shows and sort of what the slowdown from the peak looks like. But I think that there probably is sufficient demand for canola seed that taking exports by 400,000 tons or 500,000 tons probably would not be a huge problem, especially if Canadian crushers slow down. The other thing that I'll say is that, I talked last week about the 1.5 billion pound forecast for U.S. soybean oil exports, and how I don't necessarily expect that it will actually be the number, but given the anticipated change in feedstock demand, I would expect that the Gulf basis would come down and U.S. exports would be more competitive. And yeah, maybe we won't get to 1.5 billion pounds, but we probably would start to see weekly export data accelerate a little bit from the historically slow start that we've seen. Now, of course, we haven't seen anything in the weekly export sales data. They remain historically low. But we did see the Gulf basis start to crack a little bit this week. So on Monday, Gulf basis dropped a couple cents from I think 9.5 to 7 cents a pound over futures. I think this is the first step in that process. Of course, one day doesn't make a trend, and the basis could pop back up today. But I don't think that world demand is so strong that that there's a huge demand pull out of the Gulf. And I think that if the feedstock demand is again closer to my expectations, there probably is additional domestic supply that can find its way to the Gulf. And if that happens, again, that would be reflected in lower Gulf basis values. So it's a very, very small step in the direction of an increase in expectations for exports. There hasn't been anything else to suggest that U.S. exports will start to accelerate and get anywhere close to 1.5 billion pounds. And again, I suspect that I probably will be reducing that as we go forward, as I sort of increase the forecast for biofuel feedstock demand. But it is something that at least is starting to trend in the direction that that I thought that it might. Again, long ways to go before we get anywhere close to that forecast, but just wanted to say that. Also, the basis in Argentina has risen and is now like 6 cents under. So the spread between Argentina and the Gulf has also narrowed pretty substantially. Still is a pretty significant, 13 cents-ish, but it's down from 20 cents or 25 cents, I think it was at one point. So about half of what it was. And if those two trends continue, then at some point I would expect to see U.S. exports start to accelerate, and perhaps accelerate substantially. But the real key to that, even if the prices come in line and everything, the real key to whether U.S. exports can get anywhere close to 1.5 billion pounds is world demand. And based on what we've seen in Argentine basis, it doesn't seem like we are where we were a couple of years ago with world demand, which was basically, if there was any available vegetable oil anywhere, there was demand there to sort of pick it up. And that doesn't seem to be the case right now. So we could get prices, U.S. Gulf and Argentina upriver prices sort of in alignment, and still maybe not get the acceleration in exports that that forecast implies. Although, again, that forecast probably will get lowered as we go forward. All right. For palm oil prices were just sort of range bound over the last week. There's two things really going on in palm oil. One is the lingering La Nina has caused some relatively minor flooding in Malaysia. It's not in the not in the largest producing regions, although there's been excess rain across both Malaysia and Indonesia. And it's not to the point where it's going to disrupt the harvest like we've seen in really bad years. So 2015 was a really bad year where production just sort of fell off a cliff at one point because of the flooding in Malaysia. Given the fact that it seems like La Nina is on its way out, I don't think that that's a long-term problem. It might be a problem here in the short term. And on top of that, we're heading into the seasonal decline in production anyway. So it might reduce production a little bit more than expected. However, we have a pretty aggressive decrease in our production built in for this season. And so my guess is that even if La Nina sort of sticks around for a little while and the rainfall remains a little bit excessive, that at the worst, the production probably comes in close to my expectations. And if the flooding isn't as bad as expected, maybe it comes in a bit above my expectations. I don't know that if it comes in above mine, that I'm really close to raising my forecast for Malaysian palm oil production for the year. I think that it would take, we would probably have to get through the end of the seasonal decrease in output and have monthly production that is substantially above what I expect going into the decline, before I would raise my forecast, just because there's a relatively strong pattern for Malaysian palm oil. But if you're going to get a situation where world demand isn't as strong as it has been in the last couple of years, the question then becomes, do they really go out as much as they have the last couple of years trying to get production up as high as possible to meet the demand? Without the demand, I think it's possible that that production would, after we get to the seasonal low, would come out of the seasonal low a little bit slower than it typically would. And so that's why I say, now, of course, if production comes in significantly above my expectations, over the next several months, if it's 300,000 or 400,000 tons a month over my expectations, I'll raise my production forecast. But if it's just a little bit above each month, then I probably am going to hold off until we get through the trough before I make any changes to my production forecast. The other thing in Malaysian palm oil is the Indonesian government is going to go forward with their 35% blend mandate for biodiesel. That will make Malaysian exports more competitive and could be that bit of extra demand that, again, sort of ultimately results in higher production. However, the coronavirus outbreak in China, even as the government sort of relaxes its zero COVID policy, the rate at which the disease is spreading in the country now suggests that even if they do sort of go to a more sort of, I guess, Western approach, then I still think that it could have a significant impact on veg oil demand in the short term. China hasn't had significant problems with COVID in the same way that the West has, and I think that that because a lot of people now in the US and Europe have either had the disease or had vaccinations or had both, the disease has kind of run its course, not entirely, of course, I think, and I'm no medical expert, obviously, But I think we probably, it's going to become, I think the common accepted expectation for the coronavirus is it sort of becomes like the seasonal flu, more or less. And we don't see the big spikes that we've seen over the last couple of years. Oh, China hasn't been through that process yet, and so they may have a big spike over the next several months, and that could really reduce their vegetable oil demand, even as Indonesia becomes less competitive. So as a result, the impact on Malaysian shipments is probably kind of a wash. And so again, I probably am not going to, over the next couple of months, I'm probably not going to make huge changes to my Malaysian export forecast, to the marketing year forecast, unless the numbers just come in substantially different than our expectations. All right, let's talk about biomass-based diesel. So the EPA data came out this week or last week, and you can see that we got a huge bump in domestic renewable diesel production. It rose to 163, or maybe a little bit more than that, million gallons. One of the big questions going into the end of this year was whether we were going to see kind of the typical increase that we see in biomass-based diesel production in the last 2 months of the year. And at least on the renewable diesel side, it looks like the answer is going to be yes. Now, on the biodiesel side, biodiesel production was basically kind of flat. And so we didn't get a big bump in it. And I think that probably is going to continue going forward. Now, we may get an increase in biodiesel production in December. It will depend a bit on the increase that we get in renewable diesel production in December, I think. But if you look at what biofuel margins are doing, biodiesel margins remain relatively strong. They actually dropped a little bit this past week, while renewable diesel margins rose a little bit. You still have this situation where renewable diesel prices in the California market are well below biodiesel prices, stripped of their credits. And so that is the primary reason that biodiesel margins have been so strong, and renewable diesel margins have kind of weakened a little bit. Now, this past week, what we saw is a decline in feedstock prices for renewable diesel. And again, remember, we use a feedstock mix of 50% tallow, 25% UCO, and 25% DCO for renewable diesel. So basically fats and greases for renewable diesel. For biodiesel, we use 75% soybean oil, 25% yellow grease. So effectively soybean oil for biodiesel. And the fat and grease prices seem to be sort of catching down to soybean oil a little bit. Now, they all had a reaction to the mandates that was very similar to the decline in soybean oil, although maybe a little bit smaller. Soybean oil kind of kept going down then a little bit after that. It seems like maybe it's found a bottom and is either stabilizing or starting to work a little bit higher. And the fats and greases may continue to move a little bit lower in the short term. And so that, we think, will help support margins through the end of the year. Into next year, we have flat to potentially higher feedstock costs built into our model. And we have energy prices in the first quarter maybe rising a little bit, but then starting to decline based on the idea that there's a strong chance we're going to have an economic slowdown in 2023. And then they start to rise again towards the end of the year. And so that combination gets you the decline in biodiesel and renewable diesel margins that you see in the chart. The key question will be RIN prices. And one of the things that I'm going to try and do over the holiday break is get caught up on my RIN balance sheet and get that, get all of that updated, because I think the big question of where production is going to be in 2023 really boils down to sort of two things. One, sort of the capacity utilization issue that I talked about last week, or maybe it was a couple weeks ago, where if you just take the mandates at face value and you don't really reduce biodiesel capacity, that suggests that renewable diesel capacity utilization drops to crazy numbers, 40–50% on average for the industry, which I don't think is necessarily true. But the other part of it is, so if you take those same set of assumptions, except you raise capacity utilization up to what it probably will be, which is 80%, give or take, probably 10% almost, then you probably are going to build RINs, or I think just almost automatically you're going to build RINs. If the mandate suggests sort of lower production and you have higher production, then you're going to build RINs. And so what I want to really understand and figure out and be able to talk to you about is where the RIN bank is and what the different production scenarios look like for the impact that they would have on the RIN bank. Now, RIN prices are obviously very closely correlated to feedstock prices. I think over the last year or two, they've been particularly correlated to feedstock prices because, unlike sort of the 4 or 5 years prior to the pandemic, the industry had a huge RIN bank, and it could draw on that RIN bank to help meet some of the individual volume obligations if production fell short. Now, it carried that RIN bank from year to year to year, surprisingly. And so they didn't do that, and prices remained correlated with feedstock costs. However, they weren't as, while the correlation was strong, I suspect that the reaction over the past year or so has been much more immediate, because there isn't that RIN bank to draw on. There isn't sort of that insurance policy to draw on. And so I think that the RIN bank is relatively low compared to history. And then the question becomes, does the industry want to go back to carrying a couple of billion RINs, or has there been a change in the industry's mindset as a whole, where some companies have been comfortable carrying deficits from year to year? And if that happens, then that would tend to offset some of the positive RIN bank balances that some of the other companies would carry. I say all of that to say that while we expect feedstock prices to go up, and that would and does imply that RIN prices will be stable to potentially rising through the year, if the industry is going to build the RIN bank back up, then maybe the forecast for RIN prices will come down a little bit. The model that we have set up doesn't really have the RIN balance doesn't really have a significant impact on the model that we have set up. It really is focused on feedstock costs in the ethanol blend wall primarily. So it would be more of a judgment call and a change from what the model wants to do, depending on how I end up sort of thinking about the RIN bank and what the industry is going to do and what that implies for either capacity utilization or renewable diesel or the rationalization of biodiesel capacity. Yeah, again, so I didn't really make any huge changes from what the model wanted to do this week. I raised the D6 a little bit, and I still think that this down here is probably a little extreme for the D6. And I made a modest change to D4 in the nearby, but other than that, just let the model kind of do its thing this week. And I think we will see what happens to RIN prices going into the end of the year. And I think that's another thing that will help us get a better understanding of where RIN prices can go in 2023. And we really see a huge increase in production in December, and the RIN bank is really low and RIN prices really increase a lot, then I think I probably will be much more comfortable sort of expecting that the industry is going to produce at levels that will build the RIN bank through the rest of the year. And that would obviously have some significant implication for the feedstock demand forecast across all of the commodities. For LCFS, really nothing new. The floor looks like it's around 65, and so we've got kind of 65 going forward. And I think last week I talked about sort of the new idea that I'm kind of kicking around about post a change in the LCFS program that is intended to raise LCFS credit prices, whether that can really be effective over the long term, or whether all that means is that more renewable diesel goes into California and it keeps prices close to sort of that, again, that marginal cost of shipping for the industry as a whole. Ultimately, I think that's where I'm going to settle, but the difficult part is kind of trying to figure out how long I think there can be an impact from any changes that CARB makes and what that impact can be. At this point, I think it's very unlikely that CARB makes enough changes to the program that you get LCFS credit prices back up at $200. But I do think that just initially the changes will have a reaction in the market and raise LCFS credit prices. It's just a question of sort of by how much. Okay, I think that is it. All right, and we have a question. Thank you so much. Yeah, so this is a great question. What are your thoughts about the NOPA oil yield? Why has domestic meal demand been so strong? So typically what you get when you go from one growing year to the next is there's a little bit of a lag in the yield, and the yield is a bit in the weeds for a lot of people, but it's something that's really important, and it's been really important over the last couple of years because it's been historically high. Now the NOPA data reported a yield that was significantly below last year's yield. And again, if you assume that sort of November is the first month where we really get into the new crop, then it is likely an indication of where yields will be going forward. And I think what we've seen, or I think potentially what it could be is what we've sort of seen in canola oil, where the yields have been relatively low compared to the last year or so, and they don't seem like they are coming back up. Now, it's the NOPA data, so it's the first cut at this, and USDA's data can vary from that, and then we'll have months of crushing afterwards where the oil yield could rise. The general rule for oil yields are that they are determined, just the amount of oil in a soybean or in an oil seed is determined by the weather while it's filling the pod. And so if you get conditions that are warmer and drier than normal, typically that means higher yielding. You get more oil yield, and if you have colder and wetter conditions, then you typically get less oil in the soybean seed. Last summer, based on my recollection, was that we didn't have a ton of rain to finish the year, but I think we had sufficient moisture to maybe keep the yields a little bit below where they were at least the prior year, when we really didn't have a lot of rain to finish the crop. And temperatures, I don't remember them being super extreme last summer, although we did have sort of an Indian summer. The Midwest had kind of an Indian summer where warm temperatures lingered for a relatively long time, but I don't remember them being sort of really extremely hot in kind of August and September. Maybe they were. My recall on Midwestern temperatures isn't what it used to be. But either way, it does look like we potentially are in for lower yields. And in fact, after the NOPA data came out, I cut my marketing year yield forecast a little bit. I think I hit it up at like 0.2 and, or sorry, thinking of, I think I hit it up at 11.9 maybe, which was kind of in line with where we were last year, upper 8s, close to 9. And I think I cut it down to like maybe 11.8. It's important because given how large the crush is, changes in yield have a significant impact on supply. And so if we get this situation where the biofuel industry is going to build a bunch of RINs and we don't rationalize biodiesel capacity, and renewable diesel capacity operates at 80%, and feedstock demand really is for soybean oil really is 11.6 billion pounds, and you have strong non-biofuel use, then the current break that we're seeing in soybean oil prices is probably not going to last through the year. Now, we kind of have, or I kind of have, soybean oil prices just sort of kind of going sideways for much of the year. I kind of think we're close to equilibrium, which is probably sort of around 65 cents. We'll give 5 cents on each side, with sort of probably a little bit more room on the downside. So if the yield is going to be substantially lower than it was last year, it could be, and you get all of those other things, it could be that that the equilibrium price rises up closer to 70 cents and maybe 70 cents sort of plus or minus. The second part of the question, why has domestic meal demand been so strong? And that is a good question that is a bit of a mystery wrapped in an enigma. So one of the ways that I look at meal demand is I look at average daily use of soybean meal demand. And historically, knowing what is happening in meal demand is key for the soybean oil market, because crushers crush for meal, and so strong meal demand implies strong crush margins, strong crush volumes, and more soybean oil supply. Over the last year, we've talked about this idea of ultimately crushers are going to need to crush for oil, and that we would need to sort of try and find something to do with the meal. Well, over the last several months, that has not been the case at all. And in fact, it's kind of been the opposite. over the last several months, I would say that it seemed to me that meal demand was strong enough that crushers could crush for meal and still supply sufficient soybean oil to the market to keep soybean oil inventories close to or at least in their historic range, and maybe even sort of moving up in that range. And if you look at the meal consumption on a daily basis, and bear with me here for just 1 second. In October, I think the average daily usage was like 113,000 tons. And if you look at what the NOPA data implies for November, it dropped off just a little bit. So maybe if it was 113 in October, I think November's was like 106,000 tons. And those were both significantly above where we were last year. Now, the way that we forecast meal demand is we look at animal slaughter numbers, primarily hog slaughter and poultry slaughter, because combined those two consume about 50% of domestic meal. And while there has been and there is projected to be continued growth in the poultry demand, hog demand is not that strong. Now, poultry is the species that eats the most soybean meal, so growth in poultry demand is more important than pork. But the growth that we have forecast for poultry demand this year is like 3.8%, and we have actually a 0.6% decrease in hog slaughter. Demand equals slaughter on some level, and so that was a 3.8% in broiler slaughter. It doesn't seem like 3.8% in broiler slaughter, especially when at least a little bit of that is offset with a decrease in hog slaughter, suggests that soybean meal usage, and I'm sorry, I was way off on the average daily use. Those were actually last year's numbers. Average daily use for meal in October was 121,000 tons. And in November, the NOPA data implies, based on my assumption for what soybean meal ending stocks are going to be at the end of the month, implies 111,000 tons per month. So the October number was up from 113,000 tons. It's a record for any month. And the implied November number is a record for November and would be looks like the fourth highest monthly average daily use. So it's not clear to me that that the slaughter numbers support those kinds of gains. Now, slaughter is obviously a lagging indicator for meal demand, since by the time that they're slaughtered, they're not going to eat anymore. And so it may be that, given the significant reduction we had in the U.S. poultry flock last year due to bird flu, that kind of seemed like it lingered on, and in fact, USDA is even kind of saying that this spring or over the winter, bird flu could be as bad as it was last year, or at least it could be substantially worse than it is in a typical year, because it's now endemic in non-commercial flocks, and so it's just kind of going to be passed back and forth from non-commercial migratory birds to commercial flocks back to migratory birds. We'll see whether that's true, but it may be that the strength in meal demand is coming from rebuilding the poultry flock, and that it just because I look at slaughter numbers, that's not really showing me what where the demand is yet. If we start to get slaughter numbers that are significantly above our expectations, then I think that will all kind of fit. If we don't, then I will start to wonder whether there hasn't been a change in the feed ration just on an average basis to include more soybean meal. Now, that doesn't make sense to me just off the top of my head, because it's not like we have meal prices that are $250 a ton or something. Meal is at the upper end of its historic range. And so I don't know what you would be replacing in the ration with meal that is relatively expensive. But again, if the slaughter numbers don't start to show a significant increase over our expectations, I think that sort of has to be the answer. And then it comes down to sort of a question of what is it replacing? Feed generally has two components, and I'm sure there are people on this call that have forgotten more about feed than I know, but on a very simple level, my level, feed generally has an energy component and a protein component, and soybean meal provides the protein component. So it's not necessarily like you can just start to shove in more soybean meal no matter what. You have to keep some balance in between energy and protein. So energy is usually represented by corn and protein by some kind of meal. And so it may be that it's not like you can substitute a bunch of meal for corn. Now you can on the margin, and that's not an absolute statement, but you're not going to substitute a lot of soybean meal for corn. So if it's a change in the feed ration, there must be another protein meal that is not that's not being used. For the dairy industry, it could be canola meal. Canola crush is come back, so that doesn't necessarily seem likely. Again, there's the rebuilding of the poultry flock, but there's not anything clear that stands out to me that I can sort of absolutely point to and say, this is why meal demand is so strong. And this is how, and the frustrating part with that is I can't then say, this is how long I expect it to be strong. I've got and have sort of continued to increase my meal demand forecast just because it has been so strong. But I'm worried that there's going to be sort of a trap door in there somewhere where we go from 111,000 tons a day to 96 for some reason, just because I don't understand exactly what is going on. But it's something that I'm paying very close attention to, and I will let you know as soon as if I get it figured out. So then they asked lysine. Yeah, I mean, you could do that, but again, it's not. I don't know. One of the questions that I had from the last WASDE report was, if you looked at the combined reduction in world wheat feeding and corn feeding that USDA was forecasting, I called some people that I know that work in the livestock industry, and I kind of said, okay, if that's really going to happen, it either implies that world animal numbers are going to be down pretty substantially, because it was like a 7.2 million ton reduction in corn and wheat feeding, or we're going to start to feed more meal because we're either going to replace something else, or we're going to need to replace that with something. And maybe that is either something like DDGs, which is kind of a combination of the protein and the energy components of feed, or something like maybe more meal along with more supplements to capture the energy part. That's really a possibility, but it just is. I think that it's unusual enough that it's not something that I assume is happening until I can kind of really know that it is and understand exactly why it is. Corn prices are historically high, but sort of so is everything else, and so and corn stocks are a little tight, but they didn't really cut U.S. feed demand. So I don't know that that same argument from the world applies to the U.S. And I don't know that we're in a situation where that has to happen anyway. It's a logical explanation, and it makes as much sense to me as anything else, because again, like I said, I just haven't been able to sort of crack this one. But again, I will keep at it and let you know. Okay, last thing. Next week, we will not have a webinar nor a report. So I hope everybody enjoys the holidays, and then we will start back up the first week of January. Next year, starting in January, I'm going to make some changes to the way that I do this webinar so that hopefully it will be a little bit more enjoyable for everybody. It will be much less me rambling on and much more sort of show and tell, either with some of the charts that we have on the website, but also with some charts that I put into a PowerPoint each week to highlight some of the points that I'm making. So hopefully that will that'll make the webinar better for everybody. Either way, I really appreciate everybody's support this past year and in your attendance for this webinar. And I hope to see you all back here in January. Have a great holidays, everybody. Bye-bye.